Why is banking so bad for e-commerce businesses? And what should e-commerce business owners and operators be thinking about when it comes to banking? Welcome to the E-commerce Finance Podcast. I'm Stephen Brown with LedgerGurus. And with me today, I have Samir Shergill, CEO and co-founder of Highbeam. Samir, thanks for joining.
Thanks for having me, Stephen.
Before we get into answering that question I posed, I'd like to understand your journey to e-commerce. How did you get into the world of e-commerce? Maybe a little bit of background to getting to where you started and built and have been growing Highbeam.
Yeah, and I think that by trade, I was a software engineer and I worked at Microsoft for a number of years on nothing related to e-commerce. But I ended up, my first foray into startup land was at a company called AppNexus, which was an ad tech startup. And so I got exposed to e-commerce businesses through the lens of them doing advertising. And I got really interested in this notion that advertising was becoming much more programmatic, something we take for granted now. But at the time, advertising was very kind of, you imagine people like the madmen on the martini lunches, like making decisions on TV ad buys versus programmatic ad spend on Meta or Google. And AppNexus was really at the start of that wave. And then when AppNexus got acquired and I started my own company, I really got interested in this idea that the other most important thing for an e-commerce business is managing their cash flow. And it's you kind of live or die by if you do that effectively. And yet the tools to do that seem so poor. And so kind of from that idea, I acted as, a poor CFO for a number of my friends' consumer brands and really started to learn more about like, if the data exists, similar to advertising, where advertising moved to programmatic, why are customers and businesses still making relatively poor financial decisions? And from there, we evolved that into, well, the answer to this is to build a banking platform that has intelligence built in. And there we are here 4 or 5 years later with Highbeam.
Gotcha. What years were you doing AppNexus?
So AppNexus was 2012 through 18 or 19 almost.
Okay. Yeah. So those were the kind of the early heydays of, I consider that like wave 2 of e-commerce. Wave 1 was really crazy. People putting in servers, think of early .com days.
The .com days, the kind of pre-Shopify website days.
I feel like wave 2 was really kind of the Shopify, Amazon Seller Central, Meta, ad platform, all that. I feel like there was a second wave, and the second wave I think really enabled so many of these businesses to grow. And I feel like we're at the end of the second wave, but that's a whole different conversation. But banking sucks for most businesses. And why is that? Why is it that the traditional banks are so bad when it comes to, let's start with something as basic as like the bank portal. I don't feel like those have evolved hardly at all in the 30 years of the internet.
It's a great question. I think that the answer lies somewhere in that banks are financial institutions with good reason, but they don't really compete on customer service, or have not historically competed on customer service or software or the experience that you have with them, because they're competing on, do I have a balance sheet? Do I have kind of regulatory and compliance checks that I need in place? And to some degree, there's been a huge barrier to entry to do that. And so the wave that happened probably the last 10 years is this new layer of neobanks, what we'll call broadly, where people like Mercury, Brex, Highbeam, others, they really act as the software layer and the intelligence layer to access the financial products, to kind of like putting ourselves in between the balance sheet from the bank. And you still have a bank in the background with the balance sheet and the regulation and all that stuff, but you allow a technology company like Highbeam to be that interface, that middle layer, and provide all the software. I think that unlocked kind of for the first time real competition. And that's good for everyone in the ecosystem. I think that now you'll see better banking solutions, more specialized banking solutions. And we're starting to see, I think, the evolution of financial services where the software will get better and the banks will be forced to adapt. So we're probably at the early stages of that. But I think for the logjam was there because there just wasn't a way to enter to provide banking service. Like there was no new bank charters historically until the last couple of years. And now suddenly everyone is applying for bank charters. But there was these like kind of like the taxi medallions in New York. Taxi experiences are so terrible because there's no new medallions. And so that was kind of the way we were stuck with, which hopefully is going to change now.
And banks don't seem to, they haven't felt like they've had any incentive to improve their technology, right? I feel like there was probably a big push in those .com days. And honestly, I don't feel like bank portals have evolved that much since those .com days. It does feel like some banks and credit unions are using the same underlying technologies. I don't know if there's like companies out there that are selling really crappy bank portal software that they implement, but I don't feel like they've evolved in line with the rest of the software ecosystem.
Yeah, that's an understatement. If you think about even like 9 to 5 and like the payment rails, which may be a little bit technical, but like ACH as a payment technology from, why is it only available within certain hours? And, anecdotally,
Yeah.
this is because, people go home and you have to like literally print on a dot matrix printer and like you have to transfer it around. And it's like things have not evolved. Like you're still sitting in an age where real-time instant payments are facilitated by third parties like PayPal, but not the banking system. And so
Mm-hmm.
it's really been this. There's been no pressure to innovate because there's not been enough of a competitive force in my mind. But increasingly, I think that is starting to happen. But historically, and especially for small businesses or mid-market businesses, I think that's been even a further underserved segment. Like a lot of banks would care about their large customers, and they care about the consumer experience to some degree because it's one size fits all. But kind of SMB mid-market, there's a servicing cost associated with it. You think of historically, you had maybe a small business banker in a small town and you sat down with him and talked about your business and he kind of gave you some advice, and that was the relationship you had at a personal level. But once they took away that personal relationship, what did they replace it with? They replaced it with a terrible portal that hasn't evolved. And so I think that that's part of the reason why banking has deteriorated over time. It's actually probably worse today than it was 50 years ago from a banking experience for a small business. But I think part of what we see that as an opportunity to redefine that through technology, and kind of that's why we exist.
Now you use a term that I don't usually hear used without some rejection, which is neobank. A lot of times when I talk to companies like you, they don't like that term. I like that term, but maybe explain what it is you guys are and how like a neobank works, because I don't know that everybody always understands this concept that are you guys a bank or how does that work? So maybe just explain how you guys function in relationship to your partner banks.
Yeah, it's a great question. And I think that the way to think about it is what we are is the software layer that sits between a partner bank and the end customer. And we are completely transparent if you go through the Highbeam UI on which bank we're partnering with, where the money sits, what the FDIC insurance is, and all those things. And so a way to think of it is instead of that bank having a branch down on the corner on the street, they opened a branch through Highbeam.
Mm.
And Highbeam is responsible for providing all the services and software so you get the best of both worlds. But the banking partner, who's Thread Bank in our case, is fully the institution that's regulated, that has the deposits. And I always encourage people to be as educated as possible on things that are important, like how much FDIC insurance do I have? Where's my money sitting? Which is the bank that has it? And the banking industry is a heavily regulated industry where, companies like us, we choose to partner with the best banks possible to be able to provide kind of this best of both worlds vision. Now, I think whatever you call it, neobank or financial platform or cash management platform, at the end of the day, we're in the business of storing and moving money on behalf of our customers by partnering with our banking partners. And we, of course, take that very seriously. And I think that's really the benefit to the end customer is you get the best of both worlds. You still get access to the financial products that you would otherwise not get because of the scale that we provide, and you get the technological services that we would do. So just to give you a specific example, something as simple as you want to set up an auto sweep from your operating account to your high yield account or money market account on a minimum balance of $200,000 or whatever it might be. Now, most small businesses would not get access to that, or we have to pay significant fees from their bank to go get that. We'll provide that for free because we're doing it through software at scale. So you kind of get the best of both worlds, where you get access to financial products and the software kind of layer that we provide to the end customer. Does that make sense?
Yeah, absolutely. And I think what people don't always understand, I worked with banks early in my career. I was doing enterprise software before I came over to do e-commerce
Yep.
accounting. There's a lot that they have to deal with, and I think they've just prioritized the compliance, the security. If you imagine what a hacker would target, right? A bank would be just like bad guys that want to steal from a bank, so do hackers. So the amount of infrastructure and spending that they have to do to secure those systems, because all those systems are, what is keeping track of everybody's money and loans and this and that and payments. There's a lot of infrastructure, and I think they've just prioritized that. But I love what's happening is the neobanks or these financial platforms are becoming um, what the consumer, what the business owners want, while the banks are doing, banking stuff, licenses and regulation and whatnot. What's really interesting is, I mean, obviously the biggest one in this space, and you mentioned them, not the biggest one, but one of the big names has been acquired by banks. Like Drex got acquired by Capital One. So I have this grand theory of maybe all these neobanks are going to get, eventually become a part of a bank, and then you'll have the best of both worlds. Or, there are others I see that are going and getting their own banking licenses,
Bank
which
charter.
is an interesting thing as well. But yeah, the portals suck. I mean, I'll give you my perspective from an accounting standpoint. Like, I feel like what we can do is so limited. And as a business owner, I own two businesses as well. I co-own LedgerGurus, and I have co-ownership in a little DTC brand, Sole Toscana. And one of the challenges I've seen is that, hey, I want to be able to move money. I don't want to go down to the branch. Like, it's annoying. I want to be able to just do things from my desk like everything else. I'm shocked, and maybe this is me just coming from enterprise software. I'm shocked that how many banking portals don't even have things as the ability to do read-only users. So like your accountant can do accounting but not have access to move money. That blows my mind that in, 30 years into the internet, that there are big banks. I won't name names, but there are big banks that have really, really crummy multi-user permissions, which seems just unbelievable for business banking, where you're going to have many people that need different levels of access. And so what I love about what like Highbeam is doing and others in the kind of the neobank realm is they're providing the experiences that we need. And that's kind of table stakes for all small businesses. But let's just talk about some of the things specifically to e-commerce. One of the biggest things that comes to my mind is lending. And I think people don't think about this a lot. The lending landscape for these businesses is really problematic. In my experience, traditional banks don't want to lend. They want to lend for buildings, for bulldozers, for trucks, warehouses, but they don't want to do working capital for inventory unless you've built up a really long history of financial profitability. Then you can go and you have clean financials. Usually what I've seen is our customers, they'll get some success. They run into challenges for needing working capital to finance inventory purchases. And the big banks, or almost any bank, doesn't help. Why is that? Why is working capital financing so problematic for e-commerce and just consumer product inventory based businesses?
That's a great question. Actually, it's part of the reason why I started Highbeam was I was acting as the CFO for my cousin's consumer brand. I was doing the math and they were taking one of these cash advances, an MCA, a merchant cash advance loan. And it seems like easy money, right? You're like at the click of a button. And this is where a lot of fintech I view as fundamentally extractive from the business and not in its best interest sometimes. Because what happened was the banks stopped lending to this segment. I'll get to why. But someone jumped in to fill the void. And it was a lot of these merchant cash advance people. I'm not to paint them all with one brush or whatever, but a lot of this is just loan sharking, right? Like the MCA product is designed to get around loan sharking rules because it doesn't have to, it has to describe an APR, but a lot of times loan sharking rules don't apply because there's just this structure they've set up whereby you might think that, for example, you're getting a $40,000 loan at 10%, right? So the way it works is I have to pay back 44,000. You're going to take it out of my revenue, and it's a 10% loan. And people that aren't financial experts might say, okay, well, that's a 10% interest loan. That's not great, but not terrible. Well, it gets worse because you're going to pay it back in 6 months. So like, okay, so it's a 20% loan. Pretty bad. It's actually worse than that because it's not like you're paying it back in one lump sum at the end of 6 months. They're taking the money away each single point in time. Now it's a 40% loan. So you're like, a 40% loan, that's insane. Like, why would you take this money? And not to say there's good reasons not to sometimes, but the point is, I think what happened was these businesses, e-commerce businesses, are working capital intensive businesses. And unless you keep a really solid eye on it, as you scale your business, your working capital needs also increase. And then you have these variabilities and ups and downs. So if you doubled your business, you probably need to double your working capital unless you're being much more efficient. And so you've got to push more money into the business. And these merchant cash advances set up to take advantage of that. A lot of businesses we see, most of their free cash flow goes to servicing their interest expenses. None of that's flowing back to the actual owner of the business. And so our point was, a lot of the banks stopped lending to this segment for two reasons. One, they don't trust the underlying data. Like they
Mm-hmm.
actually don't trust, they're not audited financials. They don't know how to read this. They don't understand the data. They don't want to do it. It's not worth their while. They'd much rather do one large $100 million loan than do 100 small $1 million loans and forget about a $100,000 loan. And then two, as you said, they're underwriting based on assets. So typically they're doing asset-based underwriting based on the building or the factory, or it's very hard for them in this model where there's a lot of inventory that turns quickly over time. You have revenue flowing in and out. They're just not designed to underwrite it. So you really need a underwriting system custom designed for this segment that is still fair and reflects the risk fairly for the business. And I think that's where we and others have tried to kind of now standardize the industry to say there is a product that can be both fair and easily available to kind of, again, get the best of both worlds, like some product that you can get access to, but yet isn't this crazy usurious rate that some of the cash advance people have.
Yeah, I mean, I feel like you call it loan sharking. I like to call it the payday lending of
Yes.
e-commerce
Yes.
businesses. But what there's to me, it's deceitful, right?
Yes.
They say it's a 10% loan, and I think consumers, we have gotten accustomed to understand APRs, annual percentage rates.
Yes.
The 10% doesn't translate to an APR. Like you were saying, when you do the math, and it's a little complex, not crazy complex,
Yes.
a little complex. To me, it's deceitful. Why isn't this regulated? Why do you feel like these companies can get away with what I would argue is deceitful advertising of rates?
Well, the cynic in me says that there's probably a lobbying group somewhere that managed to carve out an exception for MCA products. The reality is, though, that almost all these companies do have to disclose the effective APR if you ask for it. So my
Mm,
advice is always, before you take any money from anyone, doesn't matter who it is, ask them explicitly, can you tell me what you estimate the APR to be? And they will always have to give you an answer. If they don't, that's a big warning sign. We've actually built some tools as well. There's a what's the APR.com that we built that was just like put in your offer and we'll just spit out what we think the APR is just so people get a sense of this. I think one of the most important things people can do is understand the cost of capital that they're signing up for and then weigh that against the operational decisions they would have to make to not use the capital. Like, what would it, I think sometimes people try to conflate operating problems with financing solutions and saying, like, well, I have this problem, but I can solve it with $20,000. So I just take the $20,000 no matter what the cost is. And that's where the more that you can have tools or technology that can help you assess what is the cost of this money, how realistic is it that I would pay this back? And, I'm sure you talk to consumer brands all the time. Most small business owners have an intuitive sense of their sales. Like they know how much their top line is, they follow it very closely. They might have an intuitive sense of their margin or EBITDA, which is like, I make about 20%, but that's still an abstract. When it comes to their actual cash, how much did I pay in interest? How much did I actually pay myself? How much did the cash flow end up being to various sources? It's very hard to figure out, but it's also very hard to intuitively understand. And yet, at the end of the day, that's what matters and why most small business owners started businesses was to get cash out of the business. And so I think you have this, unfortunate problem where intuitively you understand sales and maybe margin, but it's really hard to get to the root of where the cash is going. And that's where these MCAs and other kind of predatory lending is what it is in some ways. They just prey on that where like, well, it's not affecting your sales or margin, but it's sucking all the cash out of the business.
yeah. And I think you brought up another really good point. The traditional banks, they're very risk adverse, right? There's a reason a lot of these big banks are big. They've been around for a long time. And when they do a loan against a building or a truck, they have some risk models that allow them to say, hey, if this loan goes up, I can sell this asset and probably get X
Yes.
amount. And they kind of know how much their default rates are, and they're going to be able to risk adjust that. I hate to say it to all those of you listening who think your inventory is amazing. Nobody knows how to sell your product but you, right? It's the value of your inventory is almost zero to anybody else because they don't know how to sell it. And so part of what I see as a problem with the big banks and the traditional banks and even the small banks is that asset is something that's not, they could convert back into cash if you have a problem with the business. And so they shy away from it. Because of that, you have these MCAs, or sometimes they're called revenue-based loans, where they're taking a piece out of every one of your sales, and they obfuscate the reality of the cost with this fixed fee which doesn't translate directly to an APR. You have to do some math. It's a little bit tricky. And so it's easy to get swooned into flexible payback terms. Oh, it's only a 10%, because that's what I see a lot of times, sometimes a little bit more. And you're like, that's comparable to what I would get for a traditional bank line of credit. And people get these loans and they, like you said, I think if people knew, hey, I had to pay an effective APR of 40%, people would probably be like, whoa, no, that's bad. That's a bad deal. And I hate it. I hate it. And I hate the fact that some of these companies they're also the key technology partners for sellers. And so you have a trusted relationship on one aspect of doing business with them. But on the other end, I feel like, it's that loan shark with a bat who's, squeezing you. You just don't know it because they've tricked you.
And I think that that's where my philosophy and what I try to do is like be as transparent as possible. And I think there it's very personal because your business is very near and dear and it's personal, right? And so when someone makes an assessment of the risk on your business and says it's a 20% or 10% or 50% risk, you take that very personally, as you should, right? But I think that my role in ideal world is to be as clear and transparent as possible as what we can and can't do and why we decided on that risk profile. And I think that's where the more obfuscation exists, the worse it is for the business. And so I think that that's where you got to be very skeptical of the easy button sometimes. And it's understand a little bit more about what is the real risk here, the cost of capital and why. And for a very early stage business, the reality might be that rather than taking a 50, 60% APR loan, you need to go find someone that's willing to invest equity in the business. And that's hard and people don't want to do it, but that sets yourself up on a much better footing for the long term than servicing this debt on an ongoing basis. And what I call it is like debt spiral treadmill, which is now you're always having to get another MCA, another MCA, another MCA, and you have no room for error. That's really what I find really, really unfortunate is when you have a business that has some product market fit. It already has something that's growing, but the reason it fails is not because of any dent of the person not working hard or the product or the marketing or any of that. It's because the financial management was such that you made a few bad decisions and then you got on this treadmill of debt and you just couldn't get out from underneath it. And so to the degree that people with, obviously working with partners like yourself, but also that can avoid that fate by access to responsible financial products, responsible lending, and just some basic good practices on cash management, cash forecasting, cash understanding. I think that makes such a difference. And it's hard sometimes for people that don't have a finance background. But I think with the tooling that exists and the services that exist now, it's possible. And that to me is the most critical thing to do from, I'll say, about $1 million of sales to $200 million of sales, right? That's the most important thing you can do for your business is to feel like you have a handle on that.
Yeah. I want to go back to something basic, which is multiple accounts. Traditional banks, it's onerous to have multiple accounts. Oftentimes there's fees. And I become a huge fan of multiple accounts within business. Personal life, it's okay to have like one checking account and kind of do a lot of things from that. Maybe you sweep some extra money out into different investment and savings accounts. But within business, I've seen a lot of interesting challenges over the years. Somebody compromises your account.
Yes.
It's a nightmare. I've had customers where this has happened and your account gets locked down. And as I've seen all these different nightmares, I've learned to set up a strategy. So I have like a money in account for my businesses. And all I use it for is taking money, and I always take the money out of that. So that account can't be compromised. And then I use different accounts for like payments. I learned a couple of years ago about the horrors of payroll tax disputes, how the states can really clamp down accounts based on if they have a lien on your business.
Yes.
I kind of segmented my accounts based on their purpose: money in, payroll, AP. And, you can get really crazy with things like Profit First, where you can have accounts for this, that, and the other that are really just holding accounts in large part. But the traditional banks do not make this easy because you have to go in and sign docs every time you set up an account. And there's usually minimum balance fees, which makes it really hard to have like these holding accounts that maybe you want to zero out periodically. This is something I love about the neobanks. You guys make it easy. Like, let's just take Highbeam example. How many bank accounts could I have with if I was working with Highbeam?
Well, we'll cap you at about 100 right now. But if you ask for more, we'll give you more. But if you can come up with a good use case, but for the first 100, we won't cap you. And that's all free of charge
Yeah.
because at the end of the day, it's just software on our side. And,
Yeah.
software
You just,
is
you- banking, I think about it like I spent a long time in software as well. It's like banking is it's just numbers in a database somewhere. And this number lives in this account, which is just another number. Why do you think banks charge so much for minimum fees? Is that just part of their historical revenue models, or
Well, I think that, again, the cynical part of me says like it's because they can. And
yeah,
once you've standardized it across multiple banks, it becomes a standard. I think at some point there might have been a servicing cost associated with the paper of someone actually
yeah,
filling something out. And, but because banking hasn't really evolved, they maintained the same structure as if it was tellers and paper, and they
yeah?
haven't moved into the software led world. And so I think part of the reason is their infrastructure is still very much rooted in this, I have people and paper and
Uh,
large buildings, and they
these
didn't
are
come
these
at
are
it from the software
costs
first. These
associated
are
to
fixed costs and unit
yeah,
costs that I have associated with the actual movement of money. Someone gives me a check and someone has to take that check and process it. Well, if someone just clicks a button and the money moves, there's no longer a person there that deposits his check and writes in the ledger and like all that stuff. But their previous structure on how they charge fees was based on that. And they're like, well, let's just carry that forward. Like, let's just make a bit more money here. And I think that that's until there was an alternative, people have just continued to do that. And so
gotcha.
that's,
And what
go, sorry.
I was going to say, and I think the average person, that's not how banks make their money necessarily. I mean, obviously they're making money, but they're making money by taking the money you put into deposits and
Correct.
lending that back out,
Correct.
investing it and doing, bank stuff, right? There,
Correct.
I'm sure there is a revenue stream from all these fees, but I'm also sure that it pales in comparison to where the core of a bank earnings come from, which is being able to redeploy capital and make money off of interest or loans or whatever.
Totally. Like bank's health is judged by its like net interest margin or how much they pay out on deposits and how much they get from their loans that they make off those deposits, right? And there's a lot of regulation to make sure that the risk is appropriate, et cetera. But that's what makes or breaks the bank. And so I think that everything else is, but it doesn't hurt, is what the way I'd put it. But I think that it's also a legacy of they view as most important to their business the ability to get deposits, yes, but more importantly, package those up and make loans on that. And that is more important, if anything else, to the deposits coming in. Whereas you, as a customer, as long as you know your deposits are safe and you know that they're FDIC insured and the federal government will stand behind them, and look, we offer $3 million by default. There's different ways in which you do this. You don't really care what the bank is doing with that money, right? You care that, of course, that it's safe and regulated, but your main premise is, do I get the experience do I want? Do I get the technology that I want? And the banks have just not had to do this. They've just, it's not been competitive. They've just not had to build the features. And what's interesting is if you look at different countries, things are even worse in Canada, where I'm from. Because in Canada,
Mm,
you have 5 banks. At least in the US, you have hundreds of banks.
yeah.
In Canada, you have 5 of them. And the portal, if you can imagine, is even worse than they are here because the barrier to entry is really high. And it's like the classic capitalism, free market problem versus like an oligopoly or like kind of whatever you might call that model. And I'm sure there's a country somewhere that has one bank and it's state run and it's even worse. And it's just the nature of things and the way they evolve. So but I do think that there is now a push towards being able to be competitive and do those things. But it is interesting to me that your banking relationship is one of the most important things that you'll have as a business. And yet that's not evolved. And the value you derive from your banking relationship has been almost a one-way street where you're giving these fees, you're paying the stuff, you're grappling with this terrible portal, and you're really not getting that much back in return. And I think that's something that will change over the next 5, 10, 15 years.
Now I want to lean back into the e-commerce specific stuff because the accounts that's kind of every business faces that. You've talked about intelligence and some of the things you guys are doing around consumer brands and particularly consumer brands selling online, which is the world that we've lived in with LedgerGurus. What is it that you guys are? Let me ask you. Well, let me back up. Why did you guys decide to do a specialized industry focus financial platform versus something that's more generic? Like we see, there's quite a few generic business platform, financial platform companies out there. What was your thesis there to focus on one industry?
Yeah, it's a great question. And, most banks or credit cards, there's the same bank or the same credit card, and the financial product applies to every single business. And in our mind, the reason that is true is because the people are the specialists. Like LedgerGurus specializes in consumer brands, or the CFO might specialize. And the reason is the intelligence is specialized. You understand the business really well, so you understand what to do. But the financial products are kind of a commodity. And it's just, you look at a credit card and all you care about is the rate that you get on cash back. Our idea was, well, if you can combine the financial products with the intelligence, then maybe you can build a better bundle or package for the customer. And so an example of that might be, because we know that credit card, your Facebook ad spend shutting off is a major problem. When you use our credit cards to pay on Facebook or Meta, we're going to make sure, one, that always goes through, but two, by being the bank account, we can toggle between 1 day cash back if you have excess cash to maximize cash back, 30 days if you don't, or 60 days if you really need the float. So the same card number, you don't have to update in Meta, but it can toggle between maximum cash back 30 days or 60 days. Now, the only way we would build this is if we understood our customer really deeply and they have a specific use case of when they spend on Meta. Now, we think the segment is large enough and interesting enough that you can actually build a very scalable business by understanding the business needs deeply, building financial products specific to those business needs, and then applying the intelligence on top to make usage of those financial products easy. So we'll do things like provide a cash forecast or other things like that you can use to plan your treasury or working capital or other things. We'll lend to these businesses. Most banks won't lend. The reason we can lend to this segment is because we're only specialized in this segment. So our underwriting takes into account your Shopify sales and your Facebook ad spend and your ROAS and things like that. So I would not be able to lend as effectively if I was also lending to restaurants and services businesses. But because I specialize in consumer brands, I can build this bundle of banking, cards, working capital, intelligence that hopefully is much better than the business saying, well, I'm going to get banking from here, loan from here, cards from here, and then try to stitch it all together to understand the picture of where my cash is and going. So that's really the thesis behind, and what we're continuing to evolve is a single financial platform to manage all your cash from the moment it hits your business, the moment it leaves. You have full visibility, and then you can maximize all these things that have been historically hard to do, like how do I maximize yield? How do I minimize interest? How do I make sure I don't pay any fees when the money leaves? We're trying to go and automate a lot of that. And it turns out that for consumer brands, because there's such a big flow of money in and out, uniquely, like let's just take a $20 million consumer brand with a 10% margin. There's 20 million coming in, $19 million or $18 million going out. And if you could optimize the 20 million in and the 18 million out, and while the cash is there and the cheeks and spikes that yielded interest, that's probably like $300,000-$400,000 worth of value, which is like 30-40% of your margin. And that's really hard to do unless you have a dedicated partner that really understands what you're trying to do.
Gotcha. Yeah, and there's so much complexity to e-commerce, and we decided to specialize in this world about 9 years ago is when we started down that path. We had a few brands, and we had kind of done everything. There's so much complexity when it comes to money with e-commerce. The ways that money gets into your business, it's more than just Shopify. Everybody knows this. Like you have to provide PayPal. You have to provide, Afterpay or whatever your forgetting the name of that category of product is. So that to your customers, you have to provide. Sometimes you have to do. There's a sense like make it easy for the customer to pay. So you go out and you get every method of payment.
Yes.
Each method has different payout methodologies. Each sales channel has different payout methodologies. Shopify kind of fans out into how they pay. Amazon's got the 2-week thing. Everybody's a little bit different. And then if you layer in wholesale, there's all sorts of weird dynamics. And that's just the money in. And then there's a lot of dynamics going on. I know you guys have some stuff around ads. And one of the things I've seen customers talk about over the years is like they want real-time accounting. And I'm kind of like, I don't know how realistic that is, because there is a level of basically applying accrual-based accounting principles.
Yes.
Which is not what I've talked about it on the podcast before, but accrual-based accounting is where most business owners get lost. But a real-time understanding of cash, that is absolutely critical. And I feel like what you guys are trying to do is understand that, and you're doing that with the lens of what these businesses are doing, instead of trying to put a lens on for every type of business under the sun.
And that's exactly right. And I think that what most people get into e-commerce because they love the product or they love the marketing. Very few get in because they love the cash flow finance part of it, right? But unfortunately, that's really critical. And what we're trying to do is say, can we give you the real-time visibility into cash, as you mentioned, but really show you what it's costing you to get the money in, what it's costing you to get the money out, what it's costing you for your loans, what it's costing you, what you're making on your yield, and then helping you optimize that. As you really can't hire other people to do optimize it for you. It's expensive. It is not worth it. But beyond the visibility, which I agree is essential, the next question is then, well, what can you do to help me minimize the cost in, minimize the cost out, maximize my yield, minimize my interest? And that's really where we try to work as closely as possible to say, like, let us help you do those things. And sometimes people are amazed by the dollar figure that's cash in their pocket that they can get from optimizing this. And it's like, it's like found money that they're not optimizing today. And that's where I really find people say like, oh, wow, I can make a couple of $100,000 a year up to a couple of $1 million a year because I'm just not optimizing this in the way I should.
Gotcha. Let's wrap up talking about a little bit about the industry. We both have focused on a specific industry. It's been a tough couple of years for these businesses. How are you feeling about consumer products and e-commerce today and looking ahead? What are the some of the thoughts that you guys are having and some of the conversations you guys are having within Highbeam about the industry?
Yeah, look, I'm an optimist. I'm long-term bullish on the industry, partly because if you look macro, the US economy runs on consumer spending. Consumer spending is tied directly to consumer goods. And the growth in consumer goods increasingly comes from emerging consumer brands, D2C brands growing, scaling quickly. That's the engine room of creation of value for this US economy, essentially. Now, I think larger and larger companies like the CPG holdcos are really becoming holdcos where they're, acquiring brands, looking at the smaller brands to grow. So I think to answer your question, I think big picture macro, I think is always, things might change, but it's quite positive. Now, in the short run, there's always what I find is a lot of these businesses, they don't have a buffer to be able to manage through, tariffs or something unbecome. And there may be long-term positive, but they don't have the buffer. And that's really where I see even healthy businesses get wiped out because the buffer didn't exist. I think there the question really is like, one, how do you create that buffer to be able to outlast the ups and downs that might exist? And then two, I think sustainable brands that are really founded on the key fundamentals of you're building something someone wants, there's brand value, they love the product, those things are eternal. I think these, I found a little bit of something on the meta algorithm that spiked for 2 months, but the product isn't great and people don't really love it. Those are ephemeral and those businesses won't succeed. But in some ways, you want the marketplace to not let those businesses succeed. So I think that my advice may be too strong a word, but what I've seen is businesses that can take somewhat of a long-term view and build a buffer and plan for the next year, 2 years, and have a sense of how they can outlast a little bit of that are the ones that survive, and the ones that are most susceptible to kind of the short-term variation are the businesses that don't have that buffer or don't have a plan or just try to hope for the best. And it's hard as a small business owner to keep track of all of these things. And so I think that's part of the challenge of this segment. But it's a very long-winded way of saying I'm a long-term optimistic. But of course, there's short-term issues, and that's just the reality of where we live.
And in my perspective, I feel like e-commerce has enabled great product ideas to test, to find a hold before they have to go out and scale, because selling wholesale is really hard. I think there was a lot of the early e-commerce businesses that were doing arbitrage. You had the drop shippers. That was kind of one of the big things.
Yep.
But really, in my mind, it's making it easier for innovation. So people that come up with really great ideas, because think about it, a lot of traditional consumer products, they get into a stable state and they don't innovate. And so what I love is seeing companies that have, hey, there's a better way, there's a better idea. They can, there's ways to make that idea into reality and then to get traction with selling online. And so in my mind, those who are more innovative, have a really strong product mindset, it's going to continue to be a great place to succeed. I do think with the challenges we've seen around tariffs and cost of marketing and all of the other things, do require a higher level of financial sophistication. which is why I think it's great to see companies like Highbeam and others who are trying to provide better tools and the ability to operate more effectively. So I am with you as well. I think I'm long-term optimistic. I just think we're going through a shift into a new wave of e-commerce.
And I think that's even to that point, with every new wave of, you mentioned the early waves, like as people got mobile devices, it turned out that they were discovering products on Instagram, and Meta became the dominant way for how people discovered products and advertising. But like before that, it was the web was new, and there's going to be new channels and new ways to connect with consumers. I really believe these businesses are going to be at the forefront of discovering new ways, and who knows in an AI-driven world how that what that it looks like. But I'm confident that those are the businesses that will crack the code first and will experiment and will find innovative. This is the innovation engine of the U.S. economy. Like I think the tech hype and all the VC-backed ecosystem is one thing, but as I go back, like the U.S. economy runs on consumer goods spending, on consumer brands. The innovation engine of that is rooted in D2C. That is where the best ideas come from when it comes to products. That is where the best ideas when it comes to marketing. That is where it'll continue to come from. And I think we should celebrate it. I think that's the part where people that are excited to go build and scale there should continue to do so. And then I think if you're focused on the fundamentals, where you have a product that you love, you have marketing that you love, you're going to go find those things. You know, there's no gimmicks and easy shortcuts in this stuff in the long run. But I think with those tools, and that's why we exist. We're excited to support that ecosystem. I think my mission, or what I really view as why I feel so kind of like proud in some ways to be able to build Highbeam, is like our customers are people that are really trying to build businesses and bring things to life, and there's optimists, and it's hard. It's hard to bring these things to life, and it's harder still if you don't have the right financial management around you. And that's the part where, uniquely for this segment, that is a critical need that we can hopefully help with. But for people that are focused on their own products and marketing as they scale this, I think that, that sense of optimism is what gives me hope. And it's why I love talking to our customers. Like I used to be in enterprise sales, both at AppNexus and earlier. And it always wore me down when I talked to some like SVP of procurement. And I'm sure in your previous life you did this. But when I talked to a brand founder who on the surface, their business may not be doing as well as, some enterprise company, but they're still optimistic. They're positive. They're trying things. And that's great. I feel like we both get to work with those people. And that's part of what I think makes me happy and energized and kind of ready to build.
Awesome. If somebody wanted to connect with you or Highbeam, what's the best way to do it?
Samir at highbeam.com, SAMIR, and our website is highbeam.com.
Awesome. Thanks for joining today.
Thanks so much, Stephen.
Today's episode is brought to you by LedgerGurus, your go-to team for e-commerce accounting. We handle everything from keeping your books in order and tackling sales tax to managing your inventory accounting and even acting as your fractional CFO. Basically, if it's about accounting, we've got it covered so you can focus on growing your business. Head over to ledgergurus.com and see how our team can help you level up your business today. That's LedgerGurus.com.